Good morning, good evening, good afternoon, whatever time it is when you're listening to this. Welcome to our end of August edition of On Track. I'm Rob McGregor, McGregor Wealth Management, and in this, like other episodes, I'll take you through what's happening in the world, in markets, and how that affects you. General advice warning, this production is produced for clients of McGregor Wealth Management. For those that are being advised by us on their portfolios. So for anyone that doesn't fall into that, none of this is a general advice warning. You should seek advice that's specific to your circumstances. And look, I'm talking to you from Amalfi in Italy at the moment. I'm on leave for just over 3 weeks. My lovely wife and I got married in early September. A little snapshot there, and we're enjoying a few weeks holiday in Europe. So, but the one thing I wanted to make sure I got out to you was this. Apart from that, Jody and the team are manning the fort and keeping all that going. And while I've been away, they've actually moved as well. So thank you so much, Jody and the team, and they're there for any queries that you have. And I'll be back on deck in early October. Let's get into it. So as always, we're going to cover important economic news, put into context about what's happening in the market, because it's always important to remember the market and the economy are not the same things. They're absolutely connected, but they're not the same thing. We'll tell you what's happened in those key markets, and we'll put it into perspective and go through a few themes. News highlights: RBA continues to ease. We've got a cash rate down to a historic low of 1%, potentially may go even lower before that year's out. There are some people calling it down as low as 0.5%, incredibly low and historical in our times. Reporting season has come and gone, and that's the ASX reporting season where companies report their profits. About a quarter of companies beat their profit forecasts, about 30% missed. We had about 90% of companies on the ASX are profitable, which is a good thing. But we've got low growth forecasts, so that means the growth on earnings and dividends may only grow 1% in the next year. These things are notoriously fickle, but we're definitely in a low growth world. It's important to note that the current dividend yield on the total ASX sits at around 4.5%. By the time you add franking credits to that, it's about 6.1% gross. So the Australian share market does deliver consistently good income. It's remarkably sticky, and then if you add a little bit of growth around inflation, that's not a bad return and pretty much consistent with history. And I'll talk more about that in a minute. One fascinating story during the month, not really fascinating, but indicative. There's $300 billion currently sitting in cash in Australian super and pension funds, and this money is waiting to go in the market. Interestingly enough, in Australia, our superannuation funds, the total pool of superannuation funds, is twice the size of the Australian share market. So a large part of Australian superannuation funds needs to go into other investments, including global investments, which is a good thing. That's the highest rate in the world, by the way, where our superannuation is twice as much as our market. So it means we have to have an outwardly looking focus. On the international front, look, two big themes. Ongoing trade war dominates. This is the start of a long process where we've got the US fighting China to be more transparent, to protect intellectual property, to be less manipulative, and you've got China trying to maintain their ground. It's going to go back and forward. We'll likely see some concessions before the US election next year, but the market is now just digging in, saying, business as usual. This is going to be a long battle. Continuing weak growth, we saw one specific example where the European Central Bank announces more quantitative easing. That's where they push money into the economy to stimulate the economy, and that's a sign that not much else is working. Look, the themes around this that we're going to have for a while: continued low economic growth, but I would like to just point out that low growth is still reasonable amounts of money splashing around the economy. It's a bit like if you're a doctor and you earn 300,000 one year, and then the next year you only grow by 1%, the next year you earn 303,000. There's still 303,000 to be spent, and it's the same in a low economic growth world. There's still money to be spent Still profits to be made by companies, but it's not growing as much as we would all like. But it's certainly not contracting and certainly not going backwards yet. That would constitute a recession. Much talk about that, and we'll see what happens there. At this stage, it looks like we'll just avoid a recession, but we're certainly in low economic growth times. That's matched by low inflation, so prices and wages just aren't going up that much. And that's also reflected in low interest rates, where half the world has now negative interest rates, which is kind of crazy to even think about. And the rest of the world, certainly the developed world, is sub 1%. So lowest interest rates of our lifetime. But it's fascinating. During that time, share markets continue to climb the wall of worry, as we talk about. That is, people are worried about everything, but markets still claw up and climb that wall of worry, giving good but lower returns. So important to remember that wall of worry, and I'll talk more about that in a minute. And look, here's our market context. You'll see on the right our index chart, which shows markets, the Aussie market back to 1950, our sort of framework, if you like. The markets go through three main stages. They go through occasional booms, nearly always followed by a bust, but most of the time they're sitting in that wall of worry where they climb always that wall of bad news, of worry, of concerns, where they edge their way up before eventually, when people stop worrying, they go into another boom. And that's actually the danger sign. And we certainly don't feel like we're there yet, given the amount of worry around the world. I'm going to delve into the emotion side of Mess It Up today, and one in particular, which is worry. And just a reminder, Mess It Up is just simply an analogy. The letters stand for the ways in which most people mess up their share market investing, which means that most people, and this is quite proven by statistics and research, blow up half their returns by zigging and zagging, moving all over the place, instead of just being good long-term investors. So let's have a look at worry. And I found this article, which is quite fascinating. It comes from a pretty top-rated fund manager in the States who's been around for a while. And they monitor this worry gauge. So the worry gauge is the ratio of the price of gold divided by the price of small cap stocks. Now, we own both in our portfolios, and I'll show you shortly what's happened to both those, but certainly the price of gold has been going up and small caps have been subdued to down, which is a sign that people are worrying. Now, on the left, you can see this worry gauge, and the 4 lines splits it into 5 categories, and it shows that the higher categories people get, then reflected by this chart on the right, we tend to get higher returns. This is for the 13 weeks. I call that 3 months period following that worry. And it's interesting, when worry is in the top 2 quintiles, that's quintile 4 and quintile 5, the next 3 months is often good returns, 17, 18% shown there. And that's historically going back to 1970. And it's fascinating at the moment. Certainly this chart shows what happens in December, where we've since had good returns. We've since had a spike in gold price, pushing gold further up, and we've had subdued returns on small caps. So that worry gauge will still be in that top 2 quadrants, which would suggest short term there's actually probably more chance of surprises on the upside. Now, I've seen a lot of calls on potential for market downside, although most of those would sort of agree that there's probably the potential for a 5 to 10% downturn, which there is at any time, by the way. But we do have this potential upside as well. So it's good to be in the market. Let's get into a market update. Aussie shares down 2.2% for the month of August. They've recovered all of that since, and you'll see in the chart on the top right-hand corner, the 1 year, the market had gone down during August in particular, more trade war fears, etc. But has since come back. Still flirting, can't quite get to that previous high. And you'll see that longer term chart, which goes all the way back to 1998, which shows that wall of worry quite clearly, and including the boom or the FOMO that we had in the 2000s, followed by the bust. But we're still climbing that wall of worry. We're at the high side, we're in that fair to expensive range. But in a world of low interest rates, it's very hard to determine what is fair value. General principle, the lower the rates that people get on risk-free assets like government bonds, the higher they'll pay for shares. So even though we say shares are fair to expensive, quite dangerous to be out of the market given low interest rates. Now, we still, for those with new money, new lumps of money, we still would be averaging in that money just to take advantage of the inevitable volatility that we do get, and we've seen that in the last year. Moving on to US shares, a slight negative for the month, and that is, of course, in Australian dollars. The US market's sitting around 3,000, as you can see from that bottom chart. And that bottom chart is a really long-term chart back to 1950, which shows the amazing, good, steady growth of US shares, which US shares, let's face it, is the heart of global capitalism. It's where most of the big companies of the world come out of, and it's still the heart of free enterprise, and that's why US shares are such an important part. It is certainly at the top end of that range. It's expensive without being in what we'd call boom territory. But once again, put into perspective, the alternative is sub 1% interest rates. So, and there's trillions of dollars of cash on the sidelines in the US. So while a fall of potentially 5 to 10% is always possible, and some could argue might be healthy at the moment from where US shares are, that cash will flow in very quickly if US shares start to fall. And we've seen that right throughout the month of August and right throughout the last year. When we get a downturn, cash starts to come in quickly. And because we're not starting each of those downturns from a position of boom or FOMO, it's unlikely that they're going to be more than 5 or 10%. Now, no one, myself, anyone can ever tell you exactly on these things, but we feel fairly comfortable that shares are an absolutely necessary part of your portfolios to get decent long-term growth, and quite a reasonable place to be at the moment. US small cap shares, as I talked about in that wall of worry gauge, down for the month, down just over 2%, and actually down 9% for the year. And I'll show you gold in a minute. But US small caps are absolutely affected by trade war worries. US small caps grow more for a part of the cycle, particularly the booms. They tend to grow less. US small caps have been a brilliant part of the portfolio over the last 3 and 5 years, and the 5-year return there of about 15%. So in the very, very good range without being excessive. We do view US small caps as fair value at the moment. Global leaders, so this is the top 100 companies in the world, which we hold in our active portfolios, in the care portfolios. And it's slight negative for the month, solid for the year at about 8%, 3 and 5 year returns very solid. And once again, just consistent good growth from these global leaders. And we rate that at fair to expensive at the moment. Emerging markets have felt the brunt of the US-China trade wars, although not as much as small caps, quite interesting. So down for the month again, recovered since then, by the way. So you'll see in the chart on the right, we've had a sharp upturn since those lows of August. For the year, we're sitting at 1.63%, so not very healthy growth there, but not a total disaster. And over 3 and 5 years, modest return, 6 to 8%, and we do expect this to be a place of significant growth as trade wars ultimately get resolved or the market just works it out. And then gold, have a look at this, up 9% during the month of September and gone, and pretty much come back a little bit there, but 1 year, 35%. And gold is in the portfolio because it's an important insurance hedge against worry. It tends to go up when everything else goes down, although we have some interesting phenomenons lately where share markets are still crawling up that wall of worry, but gold going up dramatically as well. So we don't rate whether gold's fair or expensive. It's just a barometer of worry in the world. One of the reasons we hold gold, like a lot of people, is that as economies around the world, the US, Japan, Europe are printing money, gold effectively becomes a currency, and its price just naturally will go up against those other currencies. So important part of the portfolio, but certainly not something that should ever dominate a portfolio because it doesn't produce income. Let's have a look at the performance of the care portfolios to the end of August, and we'll note the 1 month showing some negatives in the growth side of things. That's led to lower 3 month, 6 month, 1 year returns. Long-term returns still absolutely sound, and even the 1 year returns are pretty close to the benchmarks that we'd expect, which is shown there on the right. Our target for our balanced investors, for instance, in the care process, not counting the reserves, would be about 4.5% plus CPI, with CPI at about 2% at the moment, possibly lower than that, possibly in the 1.5s. We'll see we're well in the zone. And over the 3-year period, all of the care processes are sitting high up in the top quartile of their competitors. So very happy with the results we're getting, which is very important because that helps us to drive your long-term plans. Quick look at the property market, and we're seeing a bit more of a bottoming. On the left-hand side, you can see a bit more green in the month of August, starting to see some growth in some of those markets, including Sydney and Melbourne, both up 1.5%. Short-term measures are hard in the property market because it's not a uniform market. There's lots of different types of properties, but it's an interesting turning point. Still a lot of red ink over the year, particularly in Darwin there, but also Sydney and Melbourne down. Looks like the peak will be down about 7, 8, 9%. So pretty healthy. Perth also up in that 8% range. Brisbane less down, and I'll talk about that in a minute. But yeah, it looks like we've seen the worst of the downturn, although, as always, you never can tell. Let's have a look at what the experts think. Heron Todd White, who published their Property Clock Monthly, they've actually called Sydney and Melbourne at the bottom of the market at 6 o'clock, which is interesting. Now, markets can stay at the bottom for a long time. Perth has been sitting on the bottom of the market there for about 3 or 4 years. So just because something's at the bottom of the market doesn't mean it's going to go up. We actually think Perth is great buying at the moment. And for those of you with substantial self-managed super funds, we're probably looking to put together a property syndicate for a property or some properties in Perth at the moment. And our preferred buying for those where property is appropriate is in Perth and Brisbane, both at the bottom of the market but showing signs of recovery, and certainly properties that may show good value over the next 3 to 5 years, just because they've been down for so long. Neither Perth nor Brisbane have enjoyed the growth that Sydney and Melbourne have, and over time those markets normally catch up. Same story in units, nothing much changed there. Both Sydney and Melbourne showing at the bottom there as well. Interestingly enough, in both the unit market and the housing market, the Sunshine Coast, where our Noosa office is showing the peak of the market. Once again, towards the peak doesn't mean it's necessarily going to fall. And the Sunshine Coast market in particular was cut off from its. It often and usually ends in a crazy boom on the sunny coast. We haven't seen that this cycle, mainly because the Sydney and Melbourne markets downturn cut off our cycle. Now, whether Heron Todd White are right here and the Sunshine Coast has peaked, or whether we've still got a bit to go there, will remain to be seen. There's certainly some great opportunities still on the coast, and certainly it is a good place to invest for the long term. Let's put it all into perspective and what the current conditions mean to you, but it's steady as she goes. Markets are in a reasonable place. When the world's worrying, you actually don't need to worry that much. Stick with the plan. It's not a bad time to be buying or selling. There's probably better times to be buying if the market was low, but we certainly wouldn't suggest putting off buying without a strategy. And most of that strategy for us, for new money that's coming in the market, is dollar cost averaging. So putting it in monthly and taking advantage of any downturns to top up more of it. And that way we'll get in without ever getting the worst price, and averaging out your returns. In the long run, your entry doesn't matter as much as you think, but it matters a heap psychologically in the short run, because no one wants to feel like a deal that they got in at the wrong time in the market. But steady as she goes. Rebalancing your portfolio is a key part of when we sit down, and we do that carefully based on where we think the market's at. And as I said, we're averaging new money, and it's a good time to rebalance. So, and review as always. So let's reinforce the process before I wrap up. Always investing should be based on goals first, and those goals should be based on you, your life, and who and what's important to you. the portfolio is designed to meet those goals with a long-term view. Short-term views will drive you crazy. You see that in the ups and downs of the markets in the short term. Long-term returns are pretty consistent in investing if you stick with a plan and good quality investments and investment process. Part of that process is massive diversification, good asset allocation that's appropriate to your long-term goals, and enough liquidity to get you through any downturns, which means you never have to sell at a bad time. For most of our portfolio, for about 70% of our portfolios, we use low-cost indexing, particularly for the share market side, which enables us to get a better return relative to fees, and that strategy has proven itself well over the last 5 years. We do protect against short-term volatility by using reserves for our retired clients, that is holding enough short-term assets to get you through 3 to 4 years worth of potential downturns, and for our clients still building their wealth, dollar cost averaging in the market means every time there's a dip, we're buying on special. And of course, rebalancing regularly, which adds 0.5 to 1% to returns over time. Thank you so much for joining me on this one. Apologies, it's a fraction late. It's been hard for me to get the right technology in the right place on my trip. I'll be back in the new office very soon and look forward to catching up with most of you at some stage in the run-up to Christmas. There, I said it, I shouldn't have said it, but it'll be here before we know it. Have a great day, have a great week, have a great month. Look forward to talking to you soon.